After holding steady for several months, the Bank of Canada has cut its key interest rate by 25 points, lowering it to 2.5%. It's the first cut since March, as the central bank looks to stimulate a weakening economy. Bank of Canada Governor Tiff Macklem explained the decision at a news conference earlier.
There was a clear consensus to cut our policy rate by 25 basis points. As we have for the last couple of meetings, we considered two alternatives: hold the policy rate where we are, or cut the policy rate. I think, what tipped the balance really in favor of a cut this time was there was a clear sense that the balance of risk has shifted.
The CBC senior business reporter Peter Armstrong joins me live in our studio. So Peter, take us through the central bank's decision to cut its rate. What did Tiff Macklem mean there by the balance of risk has shifted?
So, mostly what he's talking about there is literally until 8:30 yesterday morning, the bank was more preoccupied with the notion that inflation might still be taking off. And it's still not all the way slayed. We're a little worried still that some portions of the inflation package are a little bit sticky and a little bit higher than they would like. But the threat and the weakening of the economy due to the threat of the trade war have sort of overtaken them in terms of that the balance of risk is way more concerning. What's happening in the economy, we're seeing weak growth, we're seeing jobs eliminated, we're seeing confidence down, we're seeing exports down. The sense that the economy needs a bit of structural support around it, a little bit of scaffolding, if you would, to just kind of keep it propped up. That's more important to do now, given that inflation appears, it came in at 1.9% yesterday. That's kind of right on target. There are elements of it that are still a concern, but for the most part, that inflation came in yesterday allows them to sort of pivot and say, okay, that's all right. Let's worry about the next problem, which of course is growth.
Okay, so the Bank of Canada meets two more times before the end of the year. So what economic indicators is it going to keep an eye on as it decides whether or not to cut rates even more?
Right. So, we went into this kind of with this idea that quarter point cut was basically baked in, right? Yeah. We just broadly assumed that was going to happen. And what everybody, I think, was looking for going through this release was, what are they going to tell us about that path forward? Because, as you say, they meet in October, they meet in December, they meet again in March. How many should we expect? 1 cut, 2 cuts, 3 cuts, no cuts? And the bank was very tight-lipped about where we might be. They often have a line in there about, if the broadly speaking, the economic conditions continue to weaken, the central bank will continue to cut rates. That line is gone. And instead, they're still talking about that balance of risk, which I think tells you they're still worried about inflation. Take a listen to what Tiff Macklem had to say.
At this point, inflationary pressures look a little more contained, and against that background and the background of a weakening economy that will put additional downward pressure on inflation, that tipped the balance of risks in favor of cutting our policy rate today. But we are proceeding carefully. We are going to be balancing those risks, and we don't want Canadians to have to worry about big increases in the cost of living.
The part of that that really, I think, jumps out to me is that we're proceeding carefully. And it was a very cautious note, because I think they're worried that inflation could seep up. And we saw the damage that can happen when inflation gets out of control in 2022, 2023. And they don't want to have to go through that. But they see the weakening. And tariffs, you and I have talked about this before, tariffs are a little weird on the inflation front, because they are an immediate, they spike prices in the short term, but they lower demand in the long term, so they lower prices. They kind of just inject volatility, they inject uncertainty, they inject unknowns into the economy, and trying to mitigate all those risks is a pretty tricky job.
And meantime, the U.S. Federal Reserve will announce its latest move on interest rates this afternoon. What are we expecting there, and could that decision affect Canada's economy?
So let me start with the second part first. It certainly makes the path for the Bank of Canada easier when both central banks are cutting. that makes it easier politically on everybody. If they weren't cutting and we were, or vice versa, things can get a little bit wonky. But it's really interesting to watch how this will unfold in the United States, because they're just starting to see the very beginning of an economic impact from the tariffs in the United States. Job losses, uncertainty, some sense that growth is weakening. We saw that sort of peak back in April and May and June. And so they're only really just starting to see the front end of that. And there's a great question about, was the pain caused by tariffs? The administration, the Trump administration, will say there was no pain. The economists lied to you. It was never going to be a problem. The tariffs are doing great. The question wasn't, the question was, were they averted or were they merely delayed? And we're starting to see signs that they were delayed. So how is the Federal Reserve going to address that? And remember, the Fed rate is an awful lot higher. Ours was at 2.75% this morning. It's now down to 2.5. The Fed rate it's a range, but between 4.25 and 4.5%. So they've got a lot more room to come down to get out of that restrictive zone and into something a little bit more neutral.
All right. Interesting to see what happens. Peter, thank you. The CBC's senior business reporter, Peter Armstrong.